Hi, my name is Billy Flowers, and welcome to my channel where I talk about velocity banking and how we can use this strategy to massively pay off debt. So in today's video, we're going to be talking about how do personal lines of credit work and how do we get them. So let's get started. So first off, personal line of credit is similar to a credit card. The money can be reborrowed, repaid, and then reborrowed again, meaning that I can go out and purchase something, and then when I come home, I can pay for that purchase, just log in online, pay for that purchase, and then I can go back out that same day and then go repurchase something again with that same money. So you can put money in and take money out, put money in and take money out. So it's that simple. I mean, it's a revolving tool, and you can use it as much as you want, as long as you don't go over the limit and you pay what you use. But it's reusable. So put in, take out, put in, take out, and it's not like a loan. A loan is one way. So if you pay your mortgage, if you pay a student loan, a personal loan, or even your car loan, once you pay that, what happens? Is do you get to call the car company and say, "Hey, I got an emergency, and that car payment I made, could I get that back?" They gonna look at you. They gonna say, "No, you can't get that back. What's wrong with you? No, you paid this. You better figure out some way that you better figure out some other way, because this is one way. It's a one-way street. That's all it is. Once you pay us, it's locked in. You can't get that money back. So that's just the way loans work. And lines of credit are different. You can put money in, take that same money out, pay something else, and then once you get paid, like us velocity bankers do, once you get paid, put that money right back into the line. So we're going to move on to point number two. Monthly payments are just like a credit card. Personal lines of credit are no different. They can be paid, the monthly payment can be paid anytime during the business cycle. So if you get paid once a week, if you get paid every 2 weeks, you can split your monthly payment up between every paycheck. So say for instance, you owe $500 on your credit card and you get paid every 2 weeks. Well, the first 2 weeks that you get paid, you can pay $250. And then the second 2 weeks when you get paid, you can pay the remainder $250, and your payment is satisfied. Or if you get paid every week, you can split that into four. Same deal. As long as it's paid before the end of the billing cycle, you're good. And point number three, how is interest calculated? It's also similar to a credit card, and personal lines of credit, the interest is calculated based on the ending daily balance. If you end the day with $100 balance, you're going to get charged interest on that balance. If it's 200, 1,000, 2,000, 3,000, 4,000, whatever it is, that's what you're going to get charged interest on. And to lower that interest rate, us velocity bankers, that's why we put all of our income into the line. So we're driving that balance down as low as possible. So we're paying the least amount of interest. That's what's so amazing about this strategy. Oh, and once once the end of the billing cycle is complete, they're just going to go and add up all the interest that got charged daily, and then that's what you're going to get charged at the end of the month, and that's going to be your interest charge. And point number four, the benefits. You can access the funds without reapplying. So unlike a loan, if say for instance I got a loan for $10,000 and I used it and paid it back, what's going to happen if I want another $10,000? What am I going to have to do? I'm going to have to reapply for that loan, meaning that I'm going to have to go through all the steps again. They're going to have to run my credit again. I'm going to get another hard pull on my credit, so it's going to drive my credit score back down, a few more points. With a credit card, once you get approved for this one of these bad boys, you can use it as much as you want. If I want to use it 100 times in a day, I can. As long as I'm repaying it back and I'm not running out of limit, you can use it as much as you want. And it's really flexible because you can use a line of credit or a personal line of credit to pay unexpected expenses. So, say for instance, we have some a line of credit out, and we paid it down, and we paid it down, and our cash flow is just sitting in there. What if I need some tires for my car? One of my tires blew out, but now I need to get a whole new set because I like to have a matching set of tires, right? I can just go take money right out of the line of credit and go get some tires. As long as my cash flow is good, even if I go over, but as long as my cash flow is good, say for instance I have $2,000, or let's just say $1,000 left every month in cash flow, and my tires cost $600. Well, instead of my balance going down $1,000 this month, it's just going to go down 400. But it still went down, and I got some new tires in the process. That's just how these lines of credit work. And we're going to go on to the last point. Where can I get one? One of the most important questions. And for me personally, and I think you're going to find most of these lines of credit are going to be at your local credit union. And what you're going to do to find these is this: you're going to go on Google, and you're just going to type in credit unions near me, and you should get a list that pops up. And you're just going to pick one. They got a website. Go on the website and just see if they offer any types of. It's probably gonna be under the loan part. So go under loans, see if they offer any types of line of credit. If you don't see anything online, then what do you gonna do? You gonna go old school. You gonna call them up and say, hey, do y'all offer a line of credit? And they either gonna tell you yes or no. If they tell you yes, then we got some questions to ask them, right? We gonna ask them, is this line of credit revolving? We want a line of credit. A line of credit. Credit. We don't want a loan. We want a line of credit. Lines of credit and loans are two different things. I already explained. Loans are one way. Lines of credit, revolving. So you want to make sure you're getting a line of credit. Two different things. Then you want to ask, what is the max credit that you offer? So some banks, they might go up to 25, 30,000. Some other banks might go up to 10,000, 15,000, or even maybe just 5,000. But you want to make sure that you're getting one that offers competitive rates, so competitive interest rates, and also you want to go with one that's big enough. So if you go with one that's just $5,000 and you make $5,000, or if you make more than that, one if you make $6,000. You don't want to get a line of credit that is equal, or or your income is more than what the line of credit is, because then it's not going to work right. You want to get something that's more than what you make. You also want to check for any kind of fees on the line of credit, any type of hidden fees that they might charge. Me personally, with my credit union, I don't have any of these fees, but you never know. Some of these banks, they might try to throw some fees in there if you're trying to do any kind of transactions or anything. They might throw some hidden fees in there, but most of the time you're not gonna run into any of those issues. And the final point, probably one of the most important, if not the most important: what is the minimum credit score that you need to get one of these? Because you just don't want to go into the bank, and your credit, you know how your credit is. You walking in there with a 500 or maybe a 530 credit score, and you talking about, yeah, I want to get a line of credit for $10,000. They gonna look at you after they run this credit report and be like, why'd you even waste our time? Now you got a ding on your credit report that you already knew that you was gonna get it. You was just sitting there hoping and praying that you was gonna get it, but you knew you weren't gonna get it. So you got to do your homework first. Just don't go in there and all this, like you gonna get something when you know you ain't gonna get nothing. They ain't gonna give you. They ain't gonna give you $100. because they know you probably ain't even gonna pay it back. You mean your credit score only 500, so there's a good chance you're gonna default on this credit line. So make sure you do your homework first, and if you need to work on your credit first before you get one of these, then that's what most people have to do. If you have credit cards already, I have plenty of videos showing you how to pay off debt with credit cards. And then once you get into routine of using the credit cards and paying those down, once you start paying those credit cards off, what's going to happen? Those credit card companies are going to see that you're paying those credit cards off. So credit card companies are going to start sending you more uh, cards in the mail to apply for. Your credit score is going to go up, and then they're even going to raise the limit of the existing credit card that you just paid off, just because you showed good history. And especially with velocity banking, where you're dumping all that money into it and driving that balance down, they're going to see that, and they're going to say, "Well, we're going to give this person more money because it looks like they know what they're doing." So take advantage of that. Look at your expenses. Make sure you got your expenses in line. And then once you start paying some stuff off and you get your credit score up, at least to the minimum, then you can go in there and try it and see what happens. That's how this works. So I just wanted to let's go to an example. Let's see if we get if we get approved for $10,000. I'm gonna do a live example right now. Where you see how the brain works, how the brain cells work when I do one of these scenarios. So then you can follow along. That's the beauty of these videos is you can follow along. You can pause it. You can rewind it. Just and use your own numbers. Write it down. Use your own numbers. That's how you learn. I would suggest that you write it down. Write your numbers down. Just and follow along as I do it. And then if you need to pause it, if you need to rewind it, if you get confused, then go right ahead. But let's do one right now. So say for instance, we got approved for the line of credit, like I always like to do on a lot of my videos, for $10,000. So we're gonna go for 10. That's a good number. $10,000, right? And it has a 15% interest rate. So some of y'all might be wondering, well, how do I calculate how much this is going to cost me per month without knowing? So basically, what you're going to do, it's real easy. Pull out your phone and just open up your credit card app. I mean, not your credit card app, your calculator, right? And you're just going to type in 10,000 times, you're going to type in 15 and then hit the percent sign. And you're going to get 1,500. Now, I've done this a lot of times, so I kind of have this number. I know this number by heart. Oops, not year. So the first year, you're going to get charged $1,500, right? $1,500. And then when you want to figure out how much you're going to get charged per month, what are you going to do? You're going to divide this 1,500 by 12. And you're going to get $125 per month. And then what do you want to do if you want to figure out how much you're going to get charged per day? How many days are in a year? 365. So you're going to divide that same 1,500 by 365, and you're going to get $4.10 per day. Mm-hmm. So we're just going to go through a scenario right now. I'm going to write down this is a generic scenario. So say, for instance, we have our income here. Excuse my chicken scratch. Excuse my chicken scratch. Income, 5K. We got our expenses at 3K. Then we just so happen to, let me learn how to spell here. We just so happen to have a credit card that's also $10,000, right? How convenient. And then, of course, our cash flow is the difference between our income and our expenses. So we're gonna have real good cash flow here. This is a good number. $2,000 left every month. And if we have a $10,000 credit card, that's roughly about $400 a month. So our 10K CC is $400 per month. So, us velocity bankers, what are we gonna do? We just got this nice $10,000, this fresh $10,000 of this line of credit right now. We're gonna take this $10,000 and we're going to pay this credit card off. And what is that immediately gonna do? Are we gonna still have that $400 monthly payment? Mm-mm. So this is going away, right? $400. And then our expenses are also going to go down $400 because we no longer have this bill, right? So our expenses are going to go down to $2,600. And that most important number, what's going to happen? We're going to get that cash flow, right? We're going to get this cash flow. So plus $400 in cash flow. Let me write it. All right. So now our cash flow is $2,400 per month. Mm-hmm. So now we pay the credit card off. Now we use Peter to pay Paul. That's what some people like to say. But we're gonna look at Peter over here, and we're gonna take our income, and we're gonna put that into Peter, right? So we're gonna put all our income into Peter. This is how we do it, people. That easy. So $10,000, we're gonna put all of our income into it. Now this income is just a straight $5,000. So that's if you get paid once a month, but you can get paid once every week or once every 2 weeks. It doesn't matter as long as it equals $5,000. The math is always going to work out the same. So this is going to bring the balance down to $5,000, right? And then we're going to take the same money that we put in. Then we're going to take our $2,600 expenses out, right? So we're going to add $2,600. Now I'm only going to do a few months of these. This to show you how to work. This to give you a little taste of how this works. So that's going to raise the balance up to $7,600. And you might be asking yourself, okay, so how do I calculate the interest on my own? Because I don't know. Well, we do the same thing as how we calculated this $10,000 interest, right? So we're just going to go on your calculator on your phone, type in 7,600 times 15% sign. You're going to get 1,140, right? That's what's going to be the interest calculation if you only paid the minimum monthly payment for the whole year. If we want to figure out what we're going to pay per month, we're just going to divide this by 12. So divide by 12. And that's going to equal, what we got here? 95. But you know me, I like using the interest cost on this high balance. So that was 125. So we're just gonna use 125 just because we're gonna beat these numbers anyway. But I just want to use this high interest cost just to show you that we still gonna blow this debt out the water anyway using the high interest cost, and that's just gonna leave us some room just for any kind of mistakes, anything that happens in life. Stuff happens. So that's going to raise the balance up to $7,725 at the end of month one. Now, month two, what are we going to do? repeat the same process. That's the thing about this. It's like once you get this down pat, you know that you're doing the same thing every month. Income in, expenses out, interest charge. Income in, expenses out, interest charge. Income in, right? Income. We're going to do some subtraction here. Look at that. All the way down to $2,725 that quick. Then what are we going to do now? Let me put this here for the first month so you can see. INT is interest. Now you're going to add their expenses of $2,600. Right? We're going to do a little math. Now this is beautiful because we learned this stuff in elementary school. We should all know how to add and subtract. If you don't, then pull out your phone, use your calculator. That's what I do. Makes things a lot easier. So that's 13 carry the 1, 4, 5. 53.25. And what are we going to do now? We're going to add the interest, right? Same steps. And what are we going to add the interest on? Well, I'm not going to add the interest on this number right here. I'm going to add the interest on this beginning balance right now. So we got 77.25 times 15%. That's going to equal $1,158.75. And then we're going to simply divide that by 12, and we're going to get $96.56. So now we're just going to do this math here. We got 11. That's 12. 4. $5,421.56 at the end of month 2. Now month 3. Repeat the same process. Ooh-wee. I already see this already. So now we got that income going in right now. About to drive this balance all the way down to $421. That quick. Now, of course, we gotta pay our expenses, right? So plus 2,600. Woo! Oh, my back cracking. I need to be shorter. I'm too tall for this. All right. Plus 2,600. We got 5, 6 here. We got 1, 2. That's 10. Then we got 2, 3, 4. So we got $4,021.56. Now we're going to calculate the interest off of this beginning balance at the month, right? So we got 54.21 and 56 cents times 15%. That's $813.23 divided by 12. We're going to get $67.77. I'm rounding up. So since I'm lazy, I'm going to do this in my phone. Plus $4,021.56. And we're going to get a grand total of $4,089.33, right? And that's going to be the balance at the end of month 3. All right. So month 4, what are we going to do? We're going to add our expenses because we did the flip, right? So plus 2,600. I'm going to do this quick math right here. 33, 9, 8, 6, and 6. $6,689.33. Now we got to put our income in. And what is this going to do? Ooh-wee. We got this 5,000 going in, this 5K. I'm going to drive this balance all the way down to $1,689.73. So I'm gonna move this up here so we can see. So we can see it. Now we're gonna do our interest. Same deal. The beginning balance of the month, $4,089.33 plus 15%. I mean, not plus 15%. Hello. Multiplied by 15%, we're going to get $613.40. We're going to divide that by 12. We're going to get $51.11. Then we're just going to add, right? We're going to add that plus 1689.33. We're going to get $1,740.44. Now, and that's the end of month 4, right? All right, so now what we're going to do, we're going to add our expenses. 2,600. Boom. We're going to add this up right quick. That's 13,234. $4,340.44. And you know what we got to do next, right? What's our income? $5,000? This looks like it's below that. So what we going to do? We're going to put this exact amount in. Need I say more? That's it. We done. Oh, don't let me forget. I got to put this up here so you can see it. Can't forget that. End of month 5. We're done. $10,000 wiped out in 5 months, and you got some money left sitting parked in your bank account. Ain't this crazy? The reason we did it so fast is because we had $2,400 to work with. And look how fast we knocked out this 10K. You know, I said I was only gonna do a few months, but once I started going, I had to finish it. My blood started pumping. I had to finish it just to show you the steps, and to show you that you got to write this stuff down. Write it down. It makes it a lot easier. It goes upstairs up here. Once you start writing this down and you get into the flow, get in the flow of things, because it's the same thing. And then once you're balanced after you put your income in and your expenses, once your balance is below what you're putting in, then you just do the flip, and then you start putting your expenses in first and then your income until you get this line down to zero, until you're, when, like right here, when you're left with, okay, this is my balance now, so, and it's less than what I've been putting in this whole time, my income. You're gonna put in that exact amount, zero the line out, and you're done. That's it. $2,400 of cash flow. Just imagine what you can do. I don't know. What if you had like a car for $40,000, right? $2,400 of cash flow, and it's going to take you 4 chunks, right? 5 months each. So 5, 10, 15, 20, right? 5, 10, 15, 20. 5, 10, 15, 20, right? 20 months or less, you paying off this car. It's going to be less because you're not even factoring in your regular monthly payment. Because once you make that chunk, what is that going to do to the amortized schedule? That's going to push you further down. You're going to be way ahead in the years. So that means more of your monthly payment is also going to be going towards the principal. So you're attacking the loan on the back end, right? Because you put that chunk on it, and then you're attacking the loan on the front end because of your regular monthly payment. That's how this works. So in less than 20 months, you riding around, you done. You riding around with the pink slip of the car. Now the only thing you got to worry about is the insurance and the upkeep, the maintenance on the car. That's it. And once you get over $1,000, once you get to $1,500, $2,000, or in this case $2,400, just imagine if you get any higher than this, in the 3,000s or the 4,000s. Just imagine how fast you can pay debt off. Like this 10K. Just imagine if you had, I don't know, over $3,000 or $4,000. Just imagine you can shave a couple months off of this, off of 5 months. Isn't that crazy? You're just using the beauty about this philosophy banking as you're using the dollar more than once. That's the key. You want to use the same dollar as many times as possible. You're putting money in and taking that same dollar out to pay your expenses. Cash flow stays in the line to pay it down. Put money in, take the same money out, pay your expenses. Cash flow stays in the line. That's the game. And the more times that you can use the same dollar, the more it's going to benefit you. So I hope that you found value in today's video. And don't forget to like, subscribe, and comment below. And like I always say, get that cash flow.